Hi everyone, it's Mark. Welcome back to my channel. Today I'm going to talk a little bit about stock options. I will tell you briefly what simple stock options are and how you can make money using stock options, as well as some pitfalls that you'll want to avoid. By the end of the video, you'll know how you can use options to make money and what types of mistakes you will want to avoid in order not to lose money. I'm super pumped to share this information with you. First, if you could do me a favor, if you haven't already subscribed, please do that. And as always, if you could help me out with that YouTube algorithm and smash the like button. Today I'm going to cover two types of options. I'm going to talk about call options and put options. Those are the most basic options. They can be combined in various different ways to create more complicated options, but I'm not going to cover those today. For simplification purposes, I'm only going to talk about stock options, and I'm also only going to talk about call options, because everything I say about call options can be applied directly to put options, except that with call options you're talking about buying the stock, and with put options you're talking about selling the stock. So it's just the reverse. An investor who buys a call option has the right but not the obligation to buy a certain stock at a certain price. An investor who buys a put option has the right but not the obligation to sell a certain stock at a certain price. Call options always trade in blocks of 100 shares. So for example, one option contract gives you the right to either buy or sell 100 shares of the underlying stock to that option. With options, there are three numbers that you need to be aware of. Again, for simplicity, I'll only be talking about call options, but the same terminology applies to put options. The first number is what's called the strike price. This is the price at which the underlying stock can be bought. Remember that the owner of the option has the right but not the obligation to purchase the stock at that price. They can always choose not to exercise the option, in which case the option expires and they do not buy the stock. However, if they do exercise the option, then they purchase the stock at the strike price. The second number is the expiration date. All options have an expiration date. They will waste away if you don't exercise them. An expiration date can be 30 days away for a short-term option. It can be 6 months or longer away for a longer-term option. If the investor does not specifically tell his broker to exercise the option, then that option will expire. All options expire, and all options expire on a Friday. The third number is the price of the option, also called the premium. This is the price that the buyer of the option pays to the seller of the option for the right to purchase the underlying stock at the exercise price prior to the expiration of the option. The price of the option is determined by the current relationship of the strike price to the stock price, the volatility of the stock, and the length of time until the option expires. Let me talk a little bit about why these three factors influence the option premium. A buyer of an option is only going to exercise that option if they can make money by doing so. The way an option holder makes money is by exercising the option at the strike price and then selling the stock that they just bought at the stock price. So if the current stock price is above the strike price of the option, then the holder of the option can sell and make money. Anything which makes it more likely that the option will be exercised increases the option premium. So for example, the longer the expiration date is, the more time the stock has to increase and make money for the underlying option holder when they exercise the option. Additionally, if a stock is more volatile, it moves in greater numbers, it moves in larger amounts, it's more likely that it will increase enough in order to make it worthwhile for the option holder to exercise their option and then sell the stock and make money. Finally, the lower the strike price is, the more likely the current stock price will be above that strike price. Options can be considered in the money, out of the money, or at the money. All of these terms relate to the relationship of the strike price and the current stock price. I'm going to use the following charts and option contracts to explain the option terms that I've been talking about. The underlying stocks are Apple, Microsoft, and Walmart. All of the following stocks have expiration dates of February the 19th, 2021, as you can see from this graphic. Apple is at the money. You can see from the red arrow strike price that the strike price is $135. This gives the option purchaser the right but not the obligation to buy 100 shares of Apple stock for $135 per share. At the blue arrow, you can see that the current price of Apple, the underlying stock, is $135.43. This is close enough to be considered at the money. It's very rare that the current stock price will be exactly equal to the strike price. Microsoft is at $220 and the current stock price is $244.30. So the current stock price is well above the strike price. That means that Microsoft is in the money and that the option investor has made quite a bit of money on their option purchase. Walmart is at a price of $144.75, which is well below the strike price of $155. Therefore, Walmart is considered out of the money. If these three stock prices all hold, what will happen is that the Microsoft option will undoubtedly be exercised because the difference between the stock price and the strike price is so large that the investor can make a large amount of money by selling the stock after they purchase it with their option. The other two options will expire worthless. For Walmart example, you would not want to exercise the option because you would be paying $155 for something that's only worth $144.75. My strategy is to use options to generate cash into my portfolio in order to purchase more stock. You can make many times your investment in an option if you buy it and you're correct on the stock, the direction of the stock, and the timing of the move. However, you can get most of those right and still lose your entire option premium. For example, if you're correct about the stock and the direction, but you get the timing wrong and your option expires before the stock moves enough to make money for you, then you will lose your entire option premium. I prefer to sell options. What I do is I purchase stock that I have confidence in, that I think will go up, and then I sell a call option against that. For every 100 shares of a stock that I own, I sell one call option. When I sell that call option, I get the proceeds from the option premium immediately placed into my investment portfolio. I typically sell an option that is a little bit out of the money so that the stock has a little bit of room to move up, and I'll still capture that move. And I sell an option that has about 30 days until it expires. My goal for this is that the stock will move a little or not at all, and then the option will expire worthless, and I will still hold the stock. Then when the option expires, I'll just do the same thing again, sell another call option for 30 days in the future, and keep that option premium as well. This is what happened with the Apple and the Walmart options. Those worked out nicely for me. The options are going to expire, and when they expire on Friday, the next Monday, I will sell another call option for 30 days in the future against both of these stocks. The only downside with the covered call strategy is, in fact, what happened with the Microsoft stock. That is that the stock moves so far ahead of the strike price that the option gets exercised, and you will not make as much money on the stock as you could have. So for example, in this case, the stock is sitting at about $244 versus a $220 strike price. That's a difference of $24. So unless you sold an option premium for at least $24, and I definitely didn't, I would have been better off holding the stock and capturing the gain from Microsoft. Now, what I intend to do in this case is to sell a put option against the Microsoft stock when the stock gets called away from me and I no longer have it. This will give me the obligation to purchase the stock at a lower price. So I'm hoping that the stock will drop back in value to where my put will be exercised, and I will be forced to purchase the stock that I really want to own anyway. Now, if the stock doesn't drop, or if I can't make enough money selling an option because the stock is so far away from the strike price that I desire, I probably will just stay out of Microsoft entirely and look for it to drop back down to a lower price in the future when I can buy back in. I want to talk to you about one strategy that I do not recommend. I've talked already about the covered call strategy, where you sell a call and you own the stock that you are writing the call against. However, if you don't own the stock and you write a call, that is called a naked call. In that case, your potential loss is unlimited. A stock can go down only to zero. However, it can go up to any number at all. And if you don't have the stock to sell when an option is called, you will have to buy the stock on the open market to satisfy the person you sold the call to, so that for every dollar the stock goes up, you lose $1 on your call. That is a terribly risky strategy, and I do not recommend it. I want to talk about one more thing related to calls and their being exercised, and that's dividends. Sometimes the dividends can come due where you would get paid for them during the option period. And in that case, it's not clear who is going to own the stock. The person who bought the option from you may choose to exercise their option early in order to capture that dividend. You need to be aware of when a stock company declares a dividend and what that will mean for your option, because you may think that you're going to collect the dividend, but if the option is exercised and the stock is taken away from you, the person who exercised the option would actually get the dividend, not you. That's what I think about options. If you've made it this far in the video, I would appreciate it if you would engage with me. Go ahead and leave me a comment or a question down below. I do read all my comments. Until the next video, take care of yourself. I'll see you next time. Thanks.